Good morning, good afternoon, good evening, traders. Wherever you are in the world, I hope you're doing well. I hope you're safe. I hope you're healthy. I hope you've got a big smile on your face. And I hope you're catching pips as usual. Pips of Persia here, back with another consistent weekly upload.
Stop the cap.
Okay, fine. I know I've been a bit quiet recently. Long story short, I needed to take a step back to reevaluate some things and decide how I want to approach literally the next decade of my life. Nothing bad though. So many of you send lovely messages to me on Instagram. We're a bit worried, but don't you worry. We're literally just getting started. But just to let everyone who's been asking know, as of right now, I don't do any mentorships or courses or anything. I don't plan to do mentorships or courses, but I do plan to release a lot of great information and content here on YouTube and some future collaborations that will allow you to have access to other top and experienced traders and their content as well. On a more relevant note, this video and tomorrow's video will finally lay out an intraday trading guide for you to follow, and we'll also be looking at some other overlooked but extremely crucial information. I'm going to release part 2 of this video tomorrow, and throughout these videos, for that little extra special sauce, we'll also look at a GBPUSD trade breakdown that has now achieved over a 1 to 130 risk to reward ratio. If you get value from the video and find yourself revisiting the channel, you may as well subscribe, as YouTube literally told me that 50% of you don't. But enough talk, time to get you paid. Let's start with the basics. Time frames for intraday trading. Guaranteed higher time frames such as 4 hours, such as daily, weekly, even monthly. These time frames can give you more information to tackle those intraday trades, but think about it logically. For someone who wants to be in a trade for maybe 48 to 72 hours or even less, that's only 12 to 18 candles on the 4-hour time frame, less on the daily, weekly, and the monthly. So that definitely is not enough information for us to be able to trade with and be in and out within the same couple days. Have your higher time frame areas marked up, those 4-hour areas, the higher time frame areas of importance, you can always have them marked up. But my recommendation would be to focus mostly on the hourly and below. We don't have to do the top-down analysis starting from monthly or weekly every single time that we want to do the trade. For me, the 15-minute time frame is a sweet spot to do majority of my analysis, and oftentimes I use 5 minutes and below, which includes the second-based time frames as well for my entries. Now, regarding the entry time frames being the 5 minute and below and those second-based time frames, I will be lying if I say that they're a must, but I would also be lying if I say that they don't help. Myself and a lot of other traders we've worked with have learned a lot by simply watching the 15-second or the 30-second time frames and how the price gets delivered to certain areas, how it reacts off certain areas. When you're on these lower time frames, you're able to see those market cycles play about a lot quicker, and the markets are fractal. So when you're learning something on the 15-second and the 30-second or 1 minute, you're learning some type of a behavior. This could also be extrapolated to other time frames as well. The difference is over here, every 5 or 15-second or whatever, there's a new candle. So throughout one day, you'll get access to so much data to be able to backtest, to be able to, practice and see how the price is moving and being delivered from point to point. For you to get access to those time frames, you would need to upgrade your plan on TradingView to the premium plan. It gives you a lot more than just the second-based time frames. If it is on your mind to actually purchase a pack for TradingView, then I must let you know that at the end of this month, there will be TradingView discounts. So do keep an eye on TradingView for their discounts at the end of this month. I'll leave a link in the description down below. For those of you who've never purchased a pack before, using that link can actually give you a few quid off your first purchase. And for those of you who have purchased packages before, using that link won't hurt you. So I'll leave it in the description down below. Another important factor on top of the time frame would be the day of the week or the time of day that you're actually trading. Trades can be taken during any session, don't get me wrong, but obviously during the London and New York overlap, there will be more volatility, there will be more liquidity in the markets, and probably a little bit quicker moves. I personally pay attention to London session and the session open times, such as obviously London being at 8 AM UK time or 3 AM Eastern Standard, New York being 1 PM UK time, 8 AM Eastern Standard, and New York Stock Exchange for the equities, such as US 30. For those of you who are trading those indices, it's important to keep on top of this, is the 2:30 PM UK time or 9:30 AM Eastern Standard. So I normally like to monitor the charts either around those times or maybe an hour before those times to kind of prepare myself for a specific direction that maybe I'm thinking is going to happen, or waiting to see if the session open move is going to actually tell us something important to be able to take the trades based on that later. Now, this could be any day of the week as well, but still Wednesdays and Thursdays is where I take majority of my trades. Sometimes I like to sit out on Monday to see the market develop, see what it does, see where the price is going to be delivered to, and then maybe getting into it on Tuesday, but mostly it's Wednesdays and Thursdays. Now that the basic stuff is out of the way, let's talk about technicals. A big part of our analysis revolves around three factors: Wyckoff, mitigations, and supply and demand. The schematics are where the orders are being created, the institutions getting in, the retail being trapped. It's oftentimes an indication that a move is about to happen. Mitigations and what happens after them allow us to narrow down the levels that we focus on and to know whether or not the market is likely to revisit a schematic or not. And supply and demand allow us to find specific areas of importance within schematics and to be able to narrate a storyline between different schematics, allowing us to formulate our bias. You should also pay attention to where the price has been sponsored to and not just where it's been sponsored from. Oftentimes when we focus on schematics so much, we forget that it's also important for us to know after that schematic, once we left that area of consolidation, what did the price actually do? Where did it reach? So after a session open or a period of consolidation or a schematic, ask yourself these questions. Where did the price get sponsored to? Did it reach an objective? Did it pull back to mitigate before or after reaching that objective? And objectives could be liquidity captures or invalidation of supply and demand levels or mitigation of a specific level. This also helps us to be able to formulate the storyline that I spoke about a bit earlier. Finding a storyline oftentimes gives us a very beautiful and easy path to follow to be able to take trades and be on the confident side every single time. So if you don't know where to start, jump on the hourly time frame or 15-minute time frame and start to look for those schematics, start to get your eyes used to finding those schematics, because oftentimes if you want to find that storyline, it's important to find out where the initial supply or demand was being introduced in the market, and then through mitigations and supply and demand you can figure out your new levels or levels that need to be revisited, etc, etc. So if I'm on the hourly or the 15-minute time frame, I oftentimes like to focus on the top or the bottom of a range and continue the same storyline onto the live chart. Just as an example, we can start off on the hourly time frame for GBPUSD, and we're going to look at this previous range from up here, from the mitigations that we were getting of these previous drop-based drops. One of the easiest things that I can spot instantly seeing this is an area of a very clean redistribution. So this tells me that out of this swing, especially because this redistribution is being created at the top of the range, and it seems to have been mitigating some of the higher levels, we can go ahead and consider this where the supply was being introduced at the very top of the range. So one of the most important areas of supply. Within these areas of redistribution, we can do more analysis on the lower time frames. This is something that I'll go into more detail in the next video tomorrow. But oftentimes we like to focus on the waves that have created the high of that range or the low of that range, and then we'll see where the high has been mitigating, see if it's actually closing any imbalances or tapping off any important candles, and what has actually taken place after. So in this case, it's actually pretty straightforward. This is a beautiful redistribution where it started as an accumulation, then it moved to a distribution phase, manipulating the highs, closing the imbalances, and once the high of that range was created, indeed it went ahead and extended the low of the range. Then we got a lower high. I see this again as a mitigation of the previous level, another slow moving range, slow moving market where it seems that maybe secondary levels of supply was being introduced, a final candle pushing the price up before the decline, and there it goes. But no pullback from here to come and mitigate those final levels. One of the things that's important to focus on when you're trading supply and demand, those drop-based drops or rally-based rallies, is also where they are being created. That specific level is indeed of importance, because when I focus on this period of consolidation and I focus on one of the final impulses that have created the high of that range, being this impulse over here, what I can see is that drop-based drop formation or the final stages of the consolidation was taking place above the low point of that range that created the high point. This entire range coming up or any type of pullback is going to look like a trending market, give or take. It could look different on different time frames, but generally that's what's happening, which means that any of these round-offs going higher, it's introducing some minor demand into the market. So when it starts to redistribute beforehand and then mitigate the higher levels and then take these levels, then we are, almost good to go. We can know that this is going to be the most important levels for us to focus on, as it was created above those levels. So now I have an area of that Wyckoff distribution that we can look at. Those higher levels, if they haven't been mitigated, they will be kept open. So they will be eventually mitigated at some point. Those levels will still stand. They're still valid regardless of how long it takes to come back and mitigate it. But as the price starts to move away from it more and more and more, I start to take my attention away from them, as it will make sense for an intraday perspective for me to focus on new trends being formed rather than just staying married to my directional bias and waiting for that one specific point. But continuing on from there, after that redistribution, we can see that the price was being kept below this point, once again creating lower lows and lower highs. I see these as mitigations of previous levels of supply and successfully creating new lows in the market, then going lower and lower and lower. Now this was the entire impulse coming up, reaching that point. However, you can see that that redistribution, or the high of that range, didn't initially fully sponsor the price below this impulse. So it didn't actually violate the low of the bigger trend. But what it did is pretty interesting, because it ended up approaching the lowest levels of rally-based rallies, the lowest levels of accumulation. In this case, you can even tell by the hourly time frame, without having to go to the lower time frames, that you've got an element of round off, so accumulation over here, and then clear imbalances, and a very fast moving market that needs to be rebalanced. It needs to revisit those areas. So what happened after is no surprise to see it revisit these areas, and upon another accumulation level, start to go higher and higher and higher. Now, talking of that previous level that was left open, this is where I will start to pay attention to it, as it doesn't necessarily violate the low of the bigger range, but it starts to give me a pullback, and the pullback is something that could potentially come back up to those previous levels. Within these pullbacks, especially for something like GBPUSD, it oftentimes loves to create liquidity and grab it later, and this is exactly what it's doing here, where it's creating liquidity, and this is where retail is taking a lot of sell orders, having their stop losses above or the buy stop orders above, and before you know it, it's gone ahead and grabbed the orders above those and tapped into that level. Now, I also mentioned to pay attention to price when the sessions are opening, at session opens, and see what they're doing. And it's quite interesting to see within this range, the move that actually grabbed the liquidity and tapped into the previous level of supply was indeed that New York open move. So this is where you can ask yourself, has the price reached an objective? Has it done something important? Yes, it has. In this case, it has tapped into a previous area. It has grabbed liquidity. And if you're more familiar with Wyckoff, then it goes without saying, you're already identifying this as another round off and another level of distribution. In this specific case, when you start to look at the final impulses in that range being formed at the beginning of New York, and also being a very typical manipulation above the highs and tapping into a previous supply, all of these factors added up together tells me that probably this initial impulse coming back down over here wasn't actually caused by introduction of new orders into the market. More than likely, it was caused by the liquidity that has been captured above, which means a lot of orders that have been closed, and also previous orders that have been released, which have been kept in drawdown probably ever since this was created back then. So continuing from here, you would be able to look for more distributions, and in this case you can see the clean distribution that's taking place after another slow range in the market, and once again you have the final levels of this distribution before it violates the low of that given range not being mitigated. In this specific case, you can consider that a valid and strong level of supply. Once again, you would probably want to be taking trades based on it. In this case, it didn't come back to it again, but eventually it revisited it and it did respect it in the end. Now, what's interesting to see is this storyline, or this battle of supply and demand, and how they interact with each other. Every single time it approaches a specific level of supply and demand that still has some type of an oomph within it, it will react from these levels. It will react, and if it needs to break this level, it will either retrace to mitigate specific levels that have been kept open, or it will introduce new distributions or accumulations. The same thing that happened over here. We got the first rally up as it tapped into this previous accumulation that we spoke about, and once that happened, we got a reaccumulation phase over here where it started as an accumulation and moved to a distribution, so new orders were being introduced, and boom, straight to the downside from there. By the way, I have been on the hourly time frame for this entire breakdown, but you don't have to be on the hourly time frame all the time. Do change it to lower time frames if need be. Sometimes if I can't see a specific picture on the hourly time frame or any given time frame, I will keep zooming in. I don't spend too much time on a specific time frame because I would like to continuously see those levels in a little bit more detail. So let's go ahead and focus on the 15-minute time frame a little bit. You can even see the price delivery and how beautiful it was from here down as well. One thing GBPUSD loves to do is to create liquidity before the major move takes place, and this is something that you can see it's doing over and over, not just necessarily in this picture with this trend line coming down. It grabbed it once but it respected it again, so I would imagine a lot more people were trying to get back in it, and then boom, move to the upside over here, manipulating the trend line, but not just the trend line over here, taking liquidity above all of these highs, and mitigating the highest levels of distribution. If you want to study this in your own time, there's a 5-minute level of distribution up there, and this is 21st of October at roughly around 4 a.m. UK time, so you can go ahead and study this on GBPUSD for yourself. And again, we can look at price delivery and kind of this relationship between supply and demand. You can see how over here this accumulation is in a way in battle with that supply up there. The accumulation sponsored it into the supply brought it back down to this accumulation. The accumulation has not managed to break the supply yet. The supply hasn't managed to break the accumulation yet. Same over here. Accumulation pushed it back in, but it still hasn't invalidated the supply. But now the supply has managed to push it lower than it did previously. The final move back up over here, which is creating a lower high. So yet again, the accumulation is not being as powerful as the supply. And then boom, the move finally lower over here. Even if you didn't manage to get any entries over here, you would, for the sell side, you would still be able to find other entries later, because once these moves have taken place, now you're confirmed that the direction that you're trading should be bearish. And I believe that was the top of the most recent hourly range, and ever since then the price has just been dropping and being delivered lower and lower and lower. And just to show again the relationship of supply and demand, this reaccumulation range that created more demand to sponsor the price higher, before being able to break that reaccumulation range, it created another redistribution, accumulation looking schematic, market moving up, and a distribution phase. But long story short, it's about reacting off a level, then creating more orders if it needs to be broken, or mitigating previous levels. And we can see this indeed has now been extended from the high over there, from that supply, from all of that consolidation below the low of the hourly range, which means a huge objective has indeed been reached. Now, if you're wondering about those buy positions that I mentioned, this was the entire impulse to the upside that resulted in something like a 1 to 120, 1 to 130 risk to reward ratio. To be fair, it's not just this impulse to the upside that we've caught, quite literally this impulse coming down, coming back up over there, and now this final impulse from this high going down have all been caught, and just simply identifying levels from before and waiting for them really. And yes, I know this is more of a swing term position. It wasn't exactly throughout one day that it reached those levels, but this move was initially planned as an intraday trade. If you follow me on Instagram, you've probably seen my entries as well, and the updates that I put for it were on an intraday level. Once it hit that 1 to 15 and the secondary TP of 1 to 27, a part of the order was closed and broken even, and the rest kept open overnight and over the weekend. The reason it was kept open is because as the market started to develop more and more, the price action was indicating continuation. So I didn't need to necessarily close any trades, but as it was tapping into some important areas of supply, I was closing a little bit more of the order just so I can secure some profits. So this time I wanted to make sure we have a complete breakdown, so the entire analysis and thought process was screen recorded prior to this trade execution. You thought that was going to be a quick breakdown on a 1 to 100 trade? No, you're about to see, if I'm not mistaken, probably 8 minutes of a trade breakdown and my entire thought process as to why I got in a buy position and how and which levels we identified, where was the exact entry and stop loss, and all of the lower time frame stuff as well. But before I play the video and before we finish off this video, I want to encourage you to go and study this, back test this in your own time, and in the next video, which is tomorrow, we will discuss how the trade was managed throughout the roughly around under 3 weeks that it was kept open. We'll also be diving deeper into the lower time frame analysis that you need to do, 5 minute and below for entries. So if you got value from the video, make sure to hit the like button down below, and if you want more intraday content, then definitely let me know in the comment section. I hope you enjoy and learn from the breakdown that you're about to see. It was recorded on 30th of September. I will catch you tomorrow for the full breakdown and how we manage this trade. Just a quick intraday breakdown on pound dollar. I think it's kind of setting up for a nice buy opportunity, which I want to speak about. But before we get there, it's kind of interesting to see how pound dollar has been trading extremely bearish over the past few days without giving any, deep retracement, which is kind of what we like to see, those higher areas of supply and demand to be kind of mitigated or respected for the major moves to take place. But this is a behavior that you will observe over and over and over again with pound dollar, and that you tend to be able to catch it at the top or the bottom of the range a little bit easier than as continuation trades. For example, within this range, it's quite difficult to actually be able to catch this redistribution to the downside if you don't know what you're looking for. And actually, just as a quick note, I'm not going to speak too much about this or how you would have been able to catch it right now, because that's not the purpose of this video. But I really do think it's important for me to comment on something quite obvious over here. So, in your next trades, you're able to kind of take advantage of it. This move from up here, it took place just before / during London Open. It was London that pushed this move to the downside. I don't care what session it is, but I do care that it's at the beginning of a session. That kind of tells me from quite literally the night before, even leading from London close the day before, this market has been setting up for the drop. It's literally just been redistributing or accumulating more retail orders throughout Asia to then be able to sponsor the price lower for that to now be worth the big market makers, worth their time really. So the way that I want to describe this from a technical perspective is however you want to look at this, you can. You want to look at this as accumulation, distribution, whatever. I don't care how you want to label that for yourself, but it's a matter of being adaptable to what the market gives you. As soon as at London Open, you see that we've created some type of a distribution looking schematic over here, then sponsoring the price lower than the higher time frame structural lows, then you shouldn't really be looking at any type of buy position. Maybe at that point, you're still not confirmed. You thought maybe that's a spring to the downside over here. The mitigation that comes from that high, which results to a new low yet again, should now give you that clear picture that, okay, I definitely shouldn't be looking at buy positions over here. You would be on the lower time frames looking at any type of distribution that you can find for you to be able to sell this to the downside, right? Now, with kind of the same thing in mind, I just want to describe the scenario that's happening over here. So currently, by the way, I forgot to say, it's Thursday, 30th of September. It's currently 10:30 a.m. UK time. So we are currently trading during London. Since yesterday, London close and leading into New York close, has created that low of the market, low of the pair, low of that range, which we can naturally assume these lows as at least a minor level of demand in the market, right? Where when these lows get violated, you're kind of more clear as the direction the market is likely to go. Ever since then, it's kind of given a pullback. It's invalidated a few of these lower time frame structures. Not something that we care about too much, I'm going to say, just simply because this is a lot lower time frame stuff right now. We're on the 5-minute and we're going to move on to the 1-minute right now. That little break above is not instantly going to be a bullish market for me. But what happened after is giving a much clearer picture. As this started to come up over here, this is obviously all happening throughout Asia, then yet again leading into London, we've started to get a little bit more impulsive moves. But what's very interesting to see in this case is the highest level that was formed in during Asia, or at least before London, the highest point from the lowest point of the day before. That highest point can now also be our minor supply. The same way I called this the minor demand down here. The mitigations, multiple mitigations of that highest point of supply, both have failed to break the low of that range. Both have failed to take the low. The market has come close to it in a way, maybe mitigating that level, but failing to break it. The way I'm looking at this is this level is not going to be taken this week. More than likely, this is now going to be reversed. If it was going to be taken, that mitigation, especially the second mitigation of the supply at the top, that should have taken that to the downside. That tells me we have levels of demand down here, which is quite, important, quite relevant areas of demand that we can trade based on. Now we can go to the maybe 3-minute, 1-minute time frame to start to study price action a little bit better. I've identified just the rally-based rally, in the range at the bottom over here as a potential POI. Well, to be honest with you, that's not even something that I'm currently looking at for any type of entries. As this started to reverse, ever since it reached the demand down here, it also started to print more so reaccumulation looking schematics over here as well. From maybe your preliminary supply to buying climax, giving you that proper reaccumulation schematic, or the distribution looking market then moving into an accumulation. All of this is signs of that reaccumulation with this jump across the creek and so on and so forth as well. So just to kind of study this again a little bit in more detail, I can see that this accumulation that took place within this range came off as a mitigation of this previous demand. Mitigation of this previous area was sponsored the price above that previous high within the 1-minute range that we are looking at. Remember that we are looking at a slightly different trend right now because we're on the lower time frames, okay? But from what I can see, since this accumulation has already come to the demand and has already resulted in sponsoring the price towards the high points of the previous supply that we looked at, more than likely the scenario would be either this is going to take that supply, so that accumulation is going to be enough to sponsor the price above that supply, or if not, we'll get some type of a mitigation of that supply, the market moving back down to, in a way, recharge some level of demand and then go back up. Now, this is a scenario that would be a lot easier for me to actually trade it. If it happens to take that high and then wanting to kind of give us a pullback, then obviously I'll have to kind of, adapt to the analysis slightly. But as of right now, based on what I'm seeing on the charts, something that I would love to see is some lower mitigation of these areas of, maybe imbalance you're looking at, or maybe this accumulation generally, to recharge that demand and then sponsor the price higher. Now, as I said, there is a POI down here as well that it could reach, but because of the price action that is created above that point of interest, with the reaccumulation and the accumulation, jump across creek and blah, 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 with all of these things, I don't see a necessity of it having to come back all the way down to here. So as of right now, in terms of rough areas, this kind of 330 line, give or take, roughly around there, that 330 looks really good. And as potential entries, like if we can get that 330 as our entries, that would be wonderful, because that would give us kind of stops exactly at 300. So we'll be looking at roughly around a 3 pip stop loss over here. So a little bit, I'm going to say magical if that ends up happening, if it comes down exactly to there. I don't often like to identify an exact entry and stop loss and then just trade based on that. I'd like to have a rough range that I'm looking at for my entries, and then allowing the market to tell me when it's kind of ready to reverse. These are the times that I'll be spending on the 30-second, 15-second time frames for those final lower time frame confirmations. But as of right now, to kind of finalize this part of the analysis, where we are standing is more of a bullish market for GU. Seems quite strong now, taking that high. So if it ends up coming back down over here, giving us the mitigations, that will be a phenomenal area for entries. Even if it does take this high first and then comes back down, these entries would still be valid down here. It would still be an amazing kind of opportunity to look to buy to the upside from around there. But as it's kind of taking this high now, one thing that now would be changing with my analysis is just paying slightly more attention to price action as it comes back down, instead of just buying it blindly at these levels, which more than likely I would have if we got the reversal over there. I'd simply be waiting for the price action a little bit more in this case. So maybe on the 15-second, waiting for those final proofs before I kind of actually end up taking the trade. But either way, the bullish range kind of looks really good for GU. Even if we don't kind of manage to get the exact entries and the trades, at least this kind of breakdown is giving you an idea of how you could have, for example, know that this high is about to get taken. How could you know that this market is literally about to be a bullish market reversing and going back up, or from up here, a bearish market reversing and coming back down? So you don't end up getting trapped in these consolidation moves that take place during some sessions to, in a way, make the major move during the next one. But I'm going to stop this now, which I'll come back to as an update.